What is a recession and how to invest during downturns? Recessions can have a wide-ranging impact, from individuals to businesses, long-term speculators to traders. But what is a recession and how to invest during one? Well, a recession is generally defined by 2 consecutive quarters of contracting GDP. There's likely to be suppressed activity across a range of metrics, such as retail sales, manufacturing, and employment. Increasing inflation, an inverted yield curve for U.S. Treasuries, and wage stagnation are just a few potential warning signs that a downturn is on the way. Economic slumps tend to be accompanied by negative performance of certain stocks and other assets, such as industrial commodities. But this is just an inevitable part of the business cycle, which moves in peaks and troughs. Expanding economies may see strong industrial output, increasing employment, and upward pressure on prices, reaching a peak. The recessionary stage is represented by the following period of correction, from the peak to the trough, before the recovery begins and the cycle starts anew. So, recessions are always going to happen, and you need to look to protect your portfolio in advance of when they hit. How is this done? Well, there are a range of assets that are traditionally considered as safe havens during recessionary climates, or instruments that are expected to retain their value when stocks fall. These include gold, the US dollar, the Japanese yen, US treasuries, and even certain types of stocks that are more defensive by nature. Take gold, for example. This precious metal is historically a reliable store of value in risk-off markets, as can be seen during the coronavirus pandemic. The US dollar is another asset perceived as having safe haven attributes due to its role as the world's reserve currency and backing the world's largest economy. Additionally, defensive stocks in certain sectors may perform better than more risk-on equities, such as consumer tech. While some assets retain or even increase their value in recessions, it's important to remember that those perceived to be safe havens may not always behave as expected. For example, while U.S. Treasury bonds often showed a negative correlation with the S&P 500, the early part of 2020 saw a sell-off of bonds as investors sought cash instead. Clearly, recessions can cause extreme hardship as employment, productivity, and standard of living fall. But they can also force businesses to become more efficient and better equipped for the recovery, regulate everyday costs for consumers as inflation falls, and provide undervalued stock possibilities when the market bottoms out.